Over the years, we have tapped the wisdom of great investors, and one of them is Bill Miller, who is marking his 40th year in the investment business and rarely does television interviews. Miller is the founder and chief investment officer of Miller Value Partners, a firm he founded in 1999 while working at Legg Mason, but took over completely in 2017. He holds the unrivaled record of beating the S&P 500 for 15 consecutive years from 1991 to 2005 with the Legg Mason Capital Management Value Trust Fund. His flagship Miller Opportunity Trust Fund, which he created in 1999, has $2.5 billion in assets and has beaten the S&P 500 since inception, including in the vast majority of years since he turned bullish at the market's bottom in 2009. In fact, he joins us this week to discuss his current views on the market, strategy, and a wide range of other topics. And in another edition, he will be back to discuss what he is doing in his personal portfolio, where he can make more concentrated investments. Here's the headline for that discussion. Miller has gone really big on Bitcoin. Half of his personal net worth is now in the cryptocurrency and a few related investments. We look forward to that discussion. But first, this one, starting with his assessment of a market that many observers consider to be expensive.
I think that the market is roughly fairly valued, which means that the central tendency of most stocks is to trade within some small band of what they're worth. And with a fairly valued market, you'll have a quadrant, maybe a quartile that's very expensive and a quartile that's very cheap. And I think that's in 50% in the middle are fairly priced. I think one of the things that happens is that, after a number of years of the market going up and of a good economy and of interest rates being well behaved and earnings being at records, people tend to associate that with an expensive market. And when the market is cheap, when it's really cheap, then they say there's too much risk and too much uncertainty. So I think tends to be a schizophrenia where the market is never offers to many observers any significant opportunity. It's either too risky or it's too expensive.
But to you, Bill Miller, you seem to always find things that you deem attractively valued or really way undervalued.
In most markets, that's the case. 99 was a very expensive market, and that's what ushered in 3 down years in a row for the first time since the Great Depression. But I don't think this market is terribly expensive. There's some names in the very high growth sphere, the cloud computing and software as a service, things like that. They're pretty expensive. In fact, some are very expensive in my opinion. But they're the big names in the market, Apple and Amazon and Alphabet, Meta, Facebook. I don't think any of those stocks are particularly expensive. So I think they all offer good value. We own, I think, almost every one of them, and have for a long time.
What's kind of the upside potential? And let's start with Amazon, which you've owned for a really long time.
When people ask me the best investment decision I ever made, I say buying Amazon on the IPO. And what was the worst? Ever selling a share of Amazon. Amazon is it's underperformed the market fairly significantly in the past 12 months, and that's because they're going through a very large capital spending cycle, and the market then isn't sure if they're going to earn above the cost of capital, even though they always have done that in the past. But what's interesting about Amazon particularly, so something like Alphabet's had a great year, and Amazon not so great. But what's interesting about Amazon to me is that if you mark the AWS business, the Amazon Web Services business, to a blended multiple of its major competitors in that area, such as or software as a service, such as Microsoft or Salesforce.com, then what you'll find is that AWS alone is worth almost Amazon's current market cap. We think AWS standalone business is worth about $1.5 trillion. And then the advertising business, which is growing much faster than the advertising business at Meta and at Alphabet, if you give them the average price to sales that those companies trade at, then that gets you about 95% of the way, almost 100% of the way, to Amazon's current market value. So you get the entire global retail business for free. And the other thing about Amazon is that Amazon this year will bypass UPS to deliver more packages in the US or worldwide than UPS does. And UPS has been around 100 years. And Amazon will build more warehouse space this year, 122 million square feet. To put that in perspective, Walmart has, if my memory is correct, 136 million square feet, and Walmart's been around 50 years, and Amazon came public in 1996. So We think that Amazon actually is a very good value here because the free cash flow should explode over the next few years as this capital spending cycle wears down.
One investment for a long-term diversified portfolio, and I'm going to tell you the last time you were on, which was about a year and a half ago, it was Amazon, which is up 25% since you recommended it. What would your one investment pick be today?
Well, you see this hat that I'm putting on?
You have a prop.
Yeah, that's a Bitcoin hat. And so I would say Bitcoin. And without getting into all of the nuances of Bitcoin, I would just say that I've owned Bitcoin. I started buying it around $200 a share, and it's now $56,000 a share. And I think that there is still enormous growth. There's about 120 million people who have Bitcoin wallets in the world, and that's about the size the internet was in 1997.
Wow.
And, Amazon came public in 1996, Google in 2004, and Facebook in 2012. So the adoption cycle here is very, very early days, and I think that Bitcoin, it's basically, we think of it right now as digital gold, because it's a store of value like gold is, but it's easily transportable, which gold is not. And so we think that it will ultimately overtake the market cap of gold, which is about $10 trillion right now, and Bitcoin's about $1 trillion. I heard a good argument about why you wouldn't put 1% of your liquid assets in Bitcoin. And if Bitcoin goes to zero, and it's much less likely to do that when it was 5 years ago or 7 years ago, and it'll be less likely in 5 years or more, if I'm right about it. But even if it does go to zero, you can afford to lose 1%.
Bill Miller, thank you so much for being on Wealth Track. It's always a pleasure having you. And incidentally, we will be doing another show with you on Bitcoin specifically. So we have that to look forward to as well. Thanks, Bill.
Thanks, Consuelo, and always a pleasure to come on your show.